Is S&P Global, ticker symbol SPGI, a buying opportunity or a value trap? This video will proceed as follows. It will begin with an overview of the company. Second, reasons for its recent stock sell-off. Third, the bull thesis for S&P Global. 1. Introduction. On a broad level, S&P Global is a financial services company that is ranked in the global Big Three, alongside Moody's and Morgan Stanley Capital International, or MSCI. However, on a micro level, S&P Global is actually made up of 5 distinct business segments, as shown here on its website. These are market intelligence, ratings, commodity insights, indices, and mobility. Let's explore each in turn. S&P's first business segment is ratings. This business segment provides independent credit ratings for entities that are issuing bonds, such as companies and governments. It also rates companies that are seeking to acquire other companies to enable them to raise capital. S&P does not only collect revenue from providing the initial rating, but it also receives recurring revenue as it monitors and updates this rating over the life cycle of the bond. To better understand this business segment, think of it this way. Bond issuers must obtain a credit rating for 2 reasons. Number 1, the bond issuer will not be able to access a large pool of capital if they do not receive a satisfactory credit rating. This is because many governments and institutional investors are legally or internally restricted from investing in bonds issued by entities that have not been rated as creditworthy. Number 2, the credit rating helps to reduce the coupon rate of the bond and in turn reduces the cost of borrowing for the issuer. This is because the rating presents the creditworthiness of the issuer on a scale that is accepted as a trusted global standard. This makes investing in the bonds less risky and hence investors will demand a lower risk premium. S&P's rating segment is likely to benefit from falling interest rates over the next few years because this will reduce benchmark borrowing costs and therefore stimulate more bond issuances and M&A activity. Many bond issuers who have been sitting on the sidelines over the past few years of higher interest rates are likely to resume their activities, while existing bond issuers may also take the opportunity to refinance their maturing debt at lower interest rates. S&P's rating segment also has a very strong moat. For starters, the rating segment is heavily regulated and it is difficult for new entrants to break into the market. The 2008 global financial crisis underscored the crucial need for credible and trustworthy bond ratings. Therefore, in the US, there are only a limited number of ratings agencies that are classified as nationally recognized statistical ratings organizations, or NRSROs. Without this certification, new entrants cannot compete directly with S&P. This is because many federal laws and institutional investors only invest in bonds which have been rated by NRSROs. Therefore, it will be pointless for bond issuers to obtain a credit rating from a new agency that is not recognized by most investors. Ultimately, while it is relatively easy for other companies to provide a rating service, it is much more difficult for them to replicate the reputation and credibility that S&P offers. Number 2, S&P also has a strong brand, which allows it to benefit from a network effect. Its ratings benchmark is currently trusted by investors all around the world. This motivates more bond issuers to engage S&P's services, which in turn makes its standard even more recognized by investors. This self-reinforcing cycle is difficult to break. Number 3, existing bond issuers who already engage S&P's rating services also cannot easily switch to another provider. Otherwise, this will create the impression that the client is trying to shop around for a more favorable credit rating and raise alarm bells over its creditworthiness. This will in turn cause its bonds to be perceived as more risky by investors who will demand a higher risk premium. Therefore, existing clients will suffer from higher borrowing rates if they were to switch away from S&P's rating services, and it ultimately may not be worth it. Therefore, S&P's rating segment enjoys a very high customer retention rate. Lastly, this business segment's revenue is also highly recurring in nature because even after providing the initial rating, S&P's rating segment will continue to receive revenue over the life cycle of the bond because they will have to continuously monitor and update the initial rating. Because of all these reasons, S&P's rating segment has a very strong moat and has immense operating leverage and pricing power over its customers. Even if the company raises prices every year at above the rate of inflation, it will not suffer a significant drop in demand. To reiterate, paying for S&P's rating services actually helps bond issuers to save money over the long term, because this makes investors more confident in the creditworthiness of the issuer and therefore demand a lower risk premium. For example, a bond issuer which pays a few $100,000 for a rating to verify their creditworthiness may actually end up saving millions of dollars over the life cycle of the bond from securing a lower coupon rate. Therefore, S&P's rating segment can exert very strong pricing power over its customers and consistently reports a very high operating margin of over 60%. S&P's second business segment is its indices. This business segment manages and licenses benchmark indices such as the S&P 500 and the Dow Jones Industrial Average, which underpin trillions of dollars in global funds. S&P generates revenue on a recurring basis by collecting licensing fees from all the ETFs and investment funds that track its benchmarks, such as ticker symbol VOO and SPDR. This business segment is also likely to grow into the future. As investment platforms become more accessible and digital connectivity improves, more people will begin passively investing in the stock market. This will in turn increase the assets under the management of the funds that track the S&P 500 and Dow Jones Index, which will increase S&P's licensing revenue. In essence, S&P indices is like a toll gate which collects fees from every investor who enters the stock market. The S&P indices also has a very strong moat. Number one, it owns two of the arguably most well-known indices in the world. The S&P 500 is a globally accepted benchmark that is often synonymous with the US stock market and has existed for over 60 years. The Dow Jones Index has an even longer history of 120 years. Even the legendary investor Warren Buffett himself has endorsed the S&P 500 index as the best option for passive retail investors to generate steady and consistent returns. In fact, Buffett even made a famous $1 million bet with hedge fund manager Ted Seeds in the late 2000s that the S&P 500 index fund would outperform his actively managed funds. Buffett turned out to be right on this bet, which further elevated the status of the S&P 500 index fund among passive investors. Number two, this reputation also allows the S&P 500 and Dow Jones indices to benefit from a network effect. As more investors want to invest in them, this will create more products that track these indices, which in turn generates even more investor interest, and so on. Number three, funds that currently already license S&P's indices cannot easily switch to track a different underlying index. This is because doing so would change the entire nature of the fund and possibly infringe on what was described in its initial prospectus to investors, which could expose the fund manager to legal liability. Further, switching the underlying index tracked would also be very administratively costly and inefficient. Therefore, S&P's recurring licensing fees are very predictable and consistent and only expected to continue increasing into the future. Number four, S&P benefits from immense operating leverage and economies of scale. This is because it costs the business almost nothing to license its indices to each additional fund. Therefore, it enjoys very low marginal costs and consistently achieves an operating margin above 50%. S&P's third business segment is market intelligence. This business segment licenses proprietary data, analytics, and workflow tools to other financial institutions and funds. An example of such a tool is S&P Capital IQ Pro, which is used by many investment bankers and fund managers. S&P licenses out these tools on a subscription basis and receives recurring recurring revenue. This business segment will benefit from two growth drivers. Number one, alternative asset classes like private markets are forecast to grow steadily into the future as financial markets mature and investors seek more sophisticated investments. This will increase demand for the specialized financial tools and data analytics provided by S&P Market Intelligence. Number two, the market intelligence sector is also poised to benefit from the AI revolution. For example, generative AI and advanced machine learning have proven to be highly effective at extracting deep insights from vast and unstructured datasets. Therefore, they can be applied in predictive analytics, financial modeling, and risk analysis. In fact, S&P Market Intelligence already recognized this opportunity early on and acquired an AI firm called Kensho Technologies in 2018, which is now its internal AI innovation hub. Keep in mind that this was years before ChatGPT was even launched and AI's potential had become widely appreciated. In my opinion, this shows that management is long-term oriented and actively seeks growth opportunities, which is what shareholders like to see. S&P's Market Intelligence also has a very strong competitive moat. Number one, most of its analytics data and tools are proprietary. This means that new entrants cannot simply map their data to S&P's existing tools, but instead have to undertake massive development costs to build their own tools from scratch. Therefore, it is prohibitively expensive for new entrants to compete with S&P in this market segment. Number two, S&P's Market Intelligence is a trusted brand and its data is generally perceived as accurate and reliable. Such credibility is important because clients often rely on S&P's tools to make high-stakes financial decisions. For example, banks use S&P's credit analytics tools to determine whether they should extend loans to certain clients and at what rate. Fund managers also use S&P's financial models to make investment decisions that are often worth billions of dollars. Investment bankers also use S&P's data to value companies that are involved in mergers and acquisitions. Therefore, even as financial data becomes increasingly commoditized and accessible with the rise of free sites like Seeking Alpha and Yahoo Finance, S&P's Market Intelligence can continue to maintain its competitive advantage by leveraging trust as its differentiating factor. Number three, S&P Market Intelligence also has very strong operating leverage and economies of scale. Like in the indices segment, Market Intelligence incurs very low marginal cost in licensing its existing tools and software to every additional client. Number four, existing clients are also unlikely to switch away from S&P to other financial data providers like FactSet or Refinitiv, because this would be very costly. This is because S&P's existing models are incompatible with the tools that are used by another provider, because S&P's own tools are proprietary in nature and are also highly integrated into its own models. Therefore, clients who switch to another provider will have to undertake a lengthy migration process that may take up to several years and risk losing their existing models. They will also have to become accustomed to a totally different ecosystem and API, which is very financially and administratively costly. Therefore, it is very difficult for new entrants to poach S&P's existing clients. S&P's fourth business segment is its Commodity Insights. This business segment provides pricing benchmarks and analytics for the energy and commodities markets, also on a subscription basis. For example, S&P owns the Platts pricing benchmark, which is very widely used in the commodities trading market. In fact, it is seen as the gold standard and is used to anchor billions of dollars in transactions every week. It is helpful to think of this business segment as market intelligence for the commodities sector. This business segment will benefit from two growth drivers. Number one, persistent geopolitical conflicts and supply chain disruptions will cause heightened volatility in the commodities market. This will increase trading activity, which will in turn increase demand for S&P's services, such as its pricing benchmarks and analytics tools. For example, more commodities trading firms may appear to take advantage of the increased volatility in the market, while companies which are exposed to commodities price movements will also require market data to hedge their positions. and limit their exposure to risk. Number two, the global clean energy transition will open up markets for new types of commodities and energy sources. For example, the markets for trading lithium and hydrogen fuel are fast expanding, while many other companies have also begun setting ESG targets. All these will create demand for independent data and benchmarks, which S&P is well positioned to capture. S&P's Commodity Insights also has a very strong moat because it shares very similar traits with its market intelligence business. Therefore, the same advantages apply here. S&P's fifth and final business segment is its mobility segment. This business segment provides market insights and analytics for companies in the automotive industry, such as vehicle manufacturers, suppliers, and insurers, in exchange for subscription revenue. Once again, this is essentially market intelligence but in the automotive industry context. However, since this is a relatively small and non-core business segment, we will not focus too much on it. In this next section, we will explore the reasons for S&P Global's recent stock market sell-off. From this chart, S&P Global has significantly underperformed the S&P 500 index and has dropped by almost 15% from its peak of $560 in August of 2024. Why is this so? This recent sell-off in S&P Global stock is because of weak guidance that was issued by its competitor FactSet. In September, FactSet reported its latest quarterly earnings results, which disappointed investors. It posted earnings of only $4.05 per share, which fell short of analyst targets of $4.13. Further, FactSet provided weak forward guidance for the next fiscal year. It projected subscription growth of only 4 to 6% and earnings growth of only between $16.90 to $17.60 per share, when analysts had initially expected $18.26 per share. This negatively impacted investor sentiment and caused multiple contraction in the market intelligence sector. Since S&P Global is FactSet's direct competitor in this sector, it caused S&P to also suffer a large decline in its share price. In this final section, I will explain why S&P Global remains a good investment notwithstanding FactSet's poor earnings projections that were just mentioned. The first reason is because S&P Global is a well-diversified company that is insulated from the headwinds currently facing FactSet. If you recall, S&P Global contains 5 distinct business segments. To reiterate, these are market intelligence, ratings, commodity insights, indices, and mobility. This excerpt from S&P Global's 2024 annual report breaks down each segment's contribution to the company's overall operating profit. Here is the same data from the previous table converted into a pie chart. It shows that S&P's rating segment is the largest contributor to operating profit, accounting for 46.3% of the total. Its other segments each only contribute approximately 14 to 19%, with the exception of mobility. Based on this, it is clear that S&P may not be affected by FactSet's poor earnings outlook as much as initially feared. This is because FactSet is a company that purely provides financial data and insights in competition with S&P's market intelligence segment. Therefore, while a slowdown in the market intelligence segment would affect a large segment of FactSet's revenue, this would have a relatively much smaller impact on S&P Global because market intelligence only makes up 15% of its total operating profit. The company still has 4 other business segments that are still seeing strong growth, strong competitive moats, and high operating margins. In summary, this diversified portfolio of businesses is precisely why S&P Global has managed to deliver consistent revenue and earnings growth in the past and will likely allow it to continue doing so into the future. The second bull thesis for S&P Global is that its revenue is mostly recurring in nature because most of its services are provided in the form of subscriptions and licenses. From this table, at least 80% 80% of revenue is recurring in nature in 4 of S&P's business segments. The fifth business segment, which is ratings, is not presented here because the ratings business model primarily generates revenue on a per transaction basis and not a recurring basis. Because of this high level of recurring revenue in 4 of its business segments, S&P's cash flow is highly consistent and predictable. The company's top line will be more resilient in the face of an economic downturn than other companies which do not have as much recurring revenue. Number 3, S&P Global is a fundamentally strong company which has consistently grown its top line every year over the past decade. From this chart, S&P Global's revenue per share grew at a compounded annual growth rate of 9.37% per year from 2014 to 2024. This chart overlays the company's sales growth onto its stock price over the past 5 years. We can see that the stock price has deviated from sales levels due to the recent drop. Interestingly, this brings the company's stock price back to levels seen almost 4 years ago in December of 2021, despite sales revenue having increased by 77% since then. This chart shows S&P's earnings per share over the past 10 years. The company suffered a decline to its earnings per share from 2021 to 2023, where earnings per share fell to a low of around $8 in 2023. However, this is not cause for concern because it was caused by 2 reasons that do not affect the company's fundamentals into the future. The first reason why earnings fell is because the Federal Reserve increased interest rates in 2021. This in turn reduced bond issuance and M&A activity, which caused a downturn in S&P's rating segment. However, now that the Federal Reserve has started to cut interest rates, this will instead become a positive tailwind for S&P's rating segment into the future, as mentioned earlier. The second reason why earnings fell was because the company acquired IHS Markit in 2022. This caused S&P to incur merger and integration costs, which were reflected on this chart since it shows unadjusted earnings per share. However, these costs were one-off and will not significantly affect the company's earnings per share in the future now that this acquisition has already been completed. Therefore, it is likely that S&P's earnings per share had already bottomed in 2023 and will return to consistent growth over the next few years. Number 4, S&P has consistently increased its dividends for the past 52 years. This makes it a dividend king, or a company that has consistently increased its dividends for at least 50 years. In fact, over the past decade alone, S&P Global has increased its annual dividend at a compounded annual growth rate of 11.7%, which far outpaced inflation. Currently, investors who purchase the company at a share price of about $480 will receive a dividend yield of about 0.8%. While this may not seem like much, keep in mind that the company is likely to continue increasing its dividends into the future, as it has already been doing for the past 5 decades. Further, the company is well able to sustain its dividends. From 2014 to 2024, S&P Global grew its free cash flow at an impressive compounded annual growth rate of 17.4%, which far outpaced the growth rate of its dividends. Currently, the company's trailing 12 months free cash flow payout ratio is only about 20%, which means that only 20 cents of every dollar of free cash flow is paid out as dividends. Therefore, dividend investors do not need to worry about the safety of the company's dividends. This chart shows how much the company's dividends have increased relative to its stock price over the past few years. While the stock has retraced to levels from almost 4 years ago, its dividend yield has only continued to increase. Fifth, S&P Global is also currently attractively valued. Assuming that the company will grow its free cash flow at compounded annual growth rate of 15% over the next 10 years, it is intrinsically worth $732 per share today, based on the discounted cash flow model. At the current stock price of $481, investors are purchasing the company at a 52% discount to its intrinsic value. Even if we assume a more conservative free cash flow growth growth rate of 13%, the company is still intrinsically worth about $633 per share today, marking a 31% discount. Therefore, this is a rare opportunity to purchase a fundamentally strong company with a high margin of safety. Finally, a simple visual analysis of S&P Global stock price shows that it has retraced to a key support trend line. Over the past few years, the stock price has rebounded off the dotted blue trend line 3 times. If the company gives a positive outlook in its next earnings report, which is scheduled on 30th of October 2025, then the stock may rebound off this trend line again. In conclusion, S&P Global is currently a compelling buy at $480, regardless of whether you are a growth investor, a value investor, a dividend investor, or a short-term swing trader. In my opinion, it is one of only a few hidden gems in this currently inflated market environment and deserves further attention. Thank you for watching until the end, and I'll see you in the next one.